We're in a really good spot with all of our short-term debt and feel confident we can replace it all over the next 6 to 9 months despite the current rising interest rate environment. I'm of the opinion that investor relations is one of the most important things that you can focus on as a real estate sponsor. Your customers in this business are twofold. Number one, the people who rent storage units, but even above those are the people who invest money and capital with you with expectation that you grow that money and protect that money. So the way that you treat investors is critical. The most important thing that you can do is communicate. And let's be honest, the last couple months have been crazy in the real estate world. Everybody's worried about values. Everybody's worried about interest rates. Everybody's worried about a real estate related crash. So what the investors need and want from you as a sponsor is communication. They want to hear from you. So what I'm about to read to you is a little 3-page, 1,200 word letter from me to all of my investors that I sent out yesterday. I sent it out to all 290 active investors and about 1,400 total folks who are on our list and see our offerings as they come. If you'd like to be added to this list, visit boltstorage.com/investors. To our partners, the last 4 months have been difficult to navigate. We made the decision to fix all of our floating rate debt with our primary lender at 5.94% with no fees and no prepayment penalties. We've also successfully closed 4 refinances off of our bridge product over the last 60 days, and several more in the works right now. The debt market is still active, and bankers are still working hard to earn business, and luckily we're in a position of low leverage, high debt yields, and in-place cash flow on all of our assets. The self-storage market is in a period of price discovery. Brokers aren't moving deals, and most of the deals that went under contract in the last 3 months are either retrading or dropping out of contract. It will take some time for sellers to meet the market. It'll take some time for sellers to meet the market, and they have to come to terms with the fact that they missed the top in early 2022. Finding deals over the past 6 months that pencil has been incredibly challenging. To put it in perspective with numbers, we closed $50.01 million worth of storage in 2021 across 16 deals, 32 properties, and 929,000 square feet of storage. The original basis with capital expenses and closing costs came out to $56.3 million, of which we used $34.1 million of debt and $20.9 million of cash. $1.54 million was co-invested from me and my partner, Dan. This year, if we didn't find any new deals over the next few weeks that we're going to rush to close by the end of the year, which I find unlikely, we will have closed $34.8 million across 12 deals, 17 properties, and 569,000 square feet. With the original basis, with capital expenses and closing costs of $39.6 million, of which we used $20.5 million of debt and $18.9 million of cash. $1 million has been co-invested so far from us. This decrease in volume is the reality despite doubling our investment in deal flow, most of which was spent on acquisitions and cold outreach. We also have an eager investor base. The last 4 months have been particularly frustrating for me as we missed out on deal after deal. Other groups continued to buy despite rising interest rates, and we came up empty-handed on 99% of deals that were marketed by brokers. I have Kevin Wickham largely to thank for our conservative and disciplined approach. He's my CFO. To put a long story short, this has been a tough and frustrating year. If you would have told me at the end of 2021 that we would have acquired 30% less storage in 2022, I'm not sure I would have believed you, and I definitely would have been upset to hear that. But the landscape made the decision to take a step back easier. As once you're dealing with other people's money and you have something to lose, aka a little bit of our own wealth, you take managing risk way more seriously. Investors don't pay us the big bucks to be bulls, buy everything, and take unnecessary risk. They pay us the big bucks to make sure we don't lose their money while generating appropriate risk-adjusted returns. It is a crazy environment, and I do not believe that rates will drop materially in the short term. There is an increasing chance that the real estate market sees serious distress. The decisions that we are tasked with making are not easy ones. What deals to buy, when to refinance, when to lock rates, and at what terms, and so on. But I take risk management very seriously. I am sure we will make some mistakes and poor decisions. I am sure some of the deals that we've underwritten will underwhelm in the near term. But I will continue to do everything in my power to prevent anything from sinking us. The big Extra Space acquisition that took place a month ago is fresh in our minds and remains a North Star for our business. Storage Express, a remotely operated portfolio based out of Indiana with stores in Ohio, Indiana, Illinois, Kentucky, was acquired for $590 million. The portfolio consisted of 107 self-storage facilities that were remotely managed and consisted of about 3 million square feet of storage. We knew this would happen, and I have discussed it extensively, but I did not anticipate it happening so quickly. We will see how aggressive Extra Space is in acquiring additional stores on the back of that platform. Overall, we are more tech forward than Extra Space and than Storage Express. Less traveling maintenance reps, a wider footprint, and more aggressive revenue management. Our goal is to continue to grow and fine-tune our operations until a similar opportunity arises in our business. The portfolio is performing well despite an uptick in delinquency and a slowdown in new rentals. A seasonal slowdown in storage demand in the fall and winter months is normal, and this could be simply that. However, some slowdown could definitely be attributed to the housing market cooling off and continued inflationary pressure on the consumer. Time will tell. Basically, the housing market is correlated to us because as people move, they need storage. So when less houses are transacting, less people rent storage units. Our revenue on a same-store basis is still up 25% year over year, and we're about to institute another serious rent increase in some of our better-performing stores heading into winter. We have one property in Springfield, Illinois that was very poorly managed by the previous owner, and we've struggled to get new rental traction. The lull in new acquisitions has been a blessing for our management team, and we've been able to focus on hiring and improving our systems for customer service, collections, and property improvement. We're doing exciting things on this front, and our ability to operate self-storage facilities continues to get better and better. The financial performance related to our debt levels and maturities is data we're tracking closely. We have $22.8 million of debt maturing between April 24 and December 24. We have $3.15 million of annual net operating income supporting this debt. That brings our debt yield to 13.8%. We have term sheets in place to refinance $11.7 million of this debt with 5-year product from local banks and credit unions that we hope to close in the next 45 days. We have placed $19.6 million in new debt on owned properties over the past 6 months. That means refinances on current properties. We've placed this debt sub 5.75 interest rates fixed for 5 years. We're in a really good spot with all of our short-term debt and feel confident we can replace it all over the next 6 to 9 months despite the current raising interest rate environment. On all of our properties acquired in 2021, we have $44.9 million of net operating income supporting $37.9 million of current debt, a 12.93% debt yield. And all this at an 8.71% yield on total cost. As you know, we spent $56 million to acquire this storage. Where do we go from here? Good deals worth buying are beginning to show up, and we think 2023 will be a big year of closing great deals. We have reduced our promote from 50% to 35% in light of the added risk in the market today. We're considering closing deals all cash and lowering IRR expectations to 10 to 12% with conservative underwriting. It is a crazy time, and like I said before, I take managing risk very seriously. We are not willing to do deals that put our investor capital at risk. We continue to focus on operations. Renting units and keeping our properties clean and approachable is our number one priority. Our team has grown fast, and the lull in acquisitions has allowed us to devote more time and energy to improving these areas, which we do and always have believed is the most important part of what we do and the key to our success. I would genuinely love your feedback on our strategy, our thought process, and potential blind spots, and we can be reached at investors@boltstorage.com. As always, reach out with any questions. Respectfully, Nick Huber, Principal, Bolt Storage. Juniper Square, the sponsor of this show, recently conducted some research to help you understand what real estate investment managers are doing to build stronger relationships with their investors and earn more referrals to new investors. Their new special report includes data on topics such as what factors are the most important for building investment relationships today, how technology is being used to provide a competitive edge, and the one technology integration that is driving more repeat investors and more referrals. To download this for free, visit junipersquareresearch.com. Again, to get this report for free, visit junipersquareresearch.com. Before you go, we have a new sponsor of the show, recostseg.com. And if you bought a piece of real estate, you need to get a cost segregation study done. It's what allows you to get all that sweet, sweet bonus depreciation, and it's how real estate investors like me and many others pay almost nothing in taxes on an annual basis. You can cost seg a single family rental, a short-term rental, or a large commercial property. recostseg.com is affordable and aggressive and super fast to turn them around. They've done 10 plus cost segs for me this year. They're going to do many more for me. Visit recostseg.com to learn more.